Every now and then you do get a thank you letter, even though we're the big bed insurance provider. You get that thank you letter when it does happen and it goes the right way. It feels good knowing that you were able to help that person.
Welcome to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owner Association, providing benefits and services to real estate investors and rental property owners for over 45 years. With your host, Brian Hamrick from Hamrick Investment Group.
Hello and welcome to episode 11. So last week I got an email from my lender on one of the large apartment communities that I own with my investor group. So this email was about the insurance policies that we have on this property. And I say policies because we have 4 different insurance policies for various things. Our policies had been audited by an independent auditor, and this email included a 3-page attachment of changes that the auditor needed to see in our policies. So anytime I see an email like this, I start to get very nervous because my mind immediately goes to how much is this going to cost? How much more are we going to have to pay for insurance above and beyond what we're already paying? And then my mind goes to, I don't have the expertise to even understand what they're asking for. Luckily, though, I have on my team an expert insurance broker, Mike Murphy from JB Harrison Insurance. He is the one who put these policies in place for me. So immediately I just forwarded this email to him, and he called me back very quickly and said, "Don't worry about it, Brian. I've got you covered. This is not a big deal. I'll take care of it." That's why it's so important to have a good insurance agent or a good insurance broker on your team, someone who understands that world and can help guide you to the best policies without having to spend more money than is necessary. If you are a rental property owner or you're considering investing in rental property, having the right insurance agent on your team is a key part of the puzzle. So today we're going to talk with Mike Murphy from JB Harrison Insurance and just kind of discuss what is the best type of policy to get. You know, what are the different types of policies that we have to choose from? And how do we go about choosing the best insurance agent for our needs? Tell me a little bit about what you do every day and the types of investors that you work with.
Typically, I try to work with a total account client, meaning take a look at the investor's whole portfolio or whole group of properties so we can do a couple main things. Liability is the most important thing that I stress with any client. And looking at all of their investments and all of their properties, I can help advise them properly on liability. So if their limits are different from property A to B to C, we can take a look at that.
So liability limits, you know, when I started working with you, I was pretty ignorant as to what all that means. So why don't you kind of talk to me as if we had just met.
Sure.
And I'm coming to you saying I need insurance on, say, a duplex that I'm about to buy. What are the things that you look at?
Number one, how are you buying the property? Are you buying it by yourself? Are you buying it in your individual name? Are you buying it in the name of an incorporation or an LLC? Those are all key things we would pull out in our first initial review.
Now, why would it make a difference as to how I'm buying the property? What difference does that make?
Well, the insurable interest is the key, making sure that the owner of the property is also the named insured or the first named insured on the insurance policy. So the insurable interest matches. So in the case of the unfortunate incident, you would have the proper coverage and things would line up.
So if there's a fire and it burns down and the records show that I own it in an LLC, but yet I've insured it in my personal name, that could lead to problems.
That could lead to an area of gray, I like to say. But we want to be in black and white. We want to say Brian Hamrick or ABC LLC owns this property, and that's the name on the insurance policy.
Does the ownership structure affect the cost of insurance or the difficulty in getting insurance at all?
No, not usually. Only time we would add any costs would be if Mike and Brian own a property and then we need our management company and a bunch of different additional insureds added to your property. Then those additional insureds might cost some extra dollars, but very insignificant. It just depends on who has an interest in the property.
Mm-hmm. Okay, and limits. Let's talk about limits, because that's a word you brought up. What exactly do you mean by that? Because this is where, to insurance agents, it all makes sense, because this is your world. You talk it every day. But yet, when I, as a consumer, look at the limits, a lot of times I have no idea what I'm looking at. So tell me very simply what you mean.
Okay, liability limits. What is the limit the policy will pay should you be sued. Let's use a trip and fall. A lot of times those are deemed as open and obvious, but a trip and fall is probably the most basic liability lawsuit that a property owner can face. I slip and fall on your property, or a tenant's dog bites me, and I'm suing the property owner. $100,000 limit doesn't go very far. $1 million limit goes a lot further. A $2 million limit, etc. So oftentimes with my clients, I would advise at least $1 million of liability on any property investment you make. Liability is pretty inexpensive. When you look at the cost of building coverage versus liability, it's usually worth the dollars to get at least $1 million.
Now, is that like an umbrella policy, or is that just the limit in the insurance policy itself?
The limit within the insurance policy itself. And oftentimes an umbrella would be a separate layer of protection on a separate policy that goes over and above that underlying limit. Should that underlying limit be exhausted in a serious accident or a serious incident, that umbrella would come down and follow the original policy right on top as an extra layer of protection.
You mentioned slip and fall, so that's one type of liability. Are there also different types of liability on a property?
It's mostly premises liability for a landlord. If you have a management company involved, they're going to want to be listed as additional insured because they're managing and operating that property on behalf of the owner. So they inherently have liability as well.
If they're working on a window and that window falls on somebody, they're covered as well.
Exactly. Or, for instance, I have an incident where the manager, didn't repair your handrail properly, and then the tenant comes along and puts their hand out and hurts themselves and they fall down. Well, property owner is going to get sued, and the management company is going to get sued because they should have taken care of something like that. So they're both going to want to have an interest in your policy.
And would they both, as long as both names are on the policy, then are they both covered by the, say, $1 million liability limit?
Yes. Oftentimes the management company will require the owner list them as additional insured to even have them manage the property.
Mm-hmm. If the management company has their own insurance policy, does that cover them separately? And
yes.
Would that be primary?
It depends on how if the management company is structured to pass the onus on to the property owner, they're gonna have their additional insured listed off of your policy first, and then their policy secondary. So they're protecting themselves twice.
I see. Because it's better for them to make it to cover themselves on your policy than it is on their own policy.
Yeah, pass it off to the next guy. It's what they want to do.
Mm-hmm. What do you typically see? You work with management companies?
Yes, a lot of them.
So is that how most of them structure their insurance?
If the management company knows what they're doing, they're going to want to be listed as additional insured on all of their clients' policies. So because they have an interest in that policy, in that property, not in the ownership, but in the day-to-day operation, which oftentimes can lead to issues in day-to-day operation.
Okay. Well, that's interesting. I never thought of it that way. And as the property owner, to list my management company as additional insured, what does that typically cost? Is there
$50 to $75 a year?
$50 to $75 a year. Okay.
And granted, that can vary a little bit with a company, but I would say definitely 100 or less.
Mm-hmm. Well, on a smaller property, say a single family, that's a significant amount of money.
It can be, but oftentimes on a smaller property, the management companies aren't going to be the same as if it was an apartment complex.
Mm-hmm.
I know some of the larger things I deal with, like the complexes, you're not going to see a management company come near it without listing themselves additional insured.
So, and I want to get to that. I want to talk about the larger apartment complexes because that's where you've really helped me is with some of my larger properties.
Yep.
But let's talk about the beginning investor who comes to you and they say, well, I know that the previous owner was paying $400 a year for insurance. Can you do the same thing for me? What are you normally telling them when they come to you for insurance?
Number one, I'm going to say let's look at your whole account, because if you're just getting into it, you're looking at buying your first duplex or first 4-unit or a couple single families, you're going to be best served by combining all of your insurance policies with the same company. Insurance companies consider rentals more of a high-risk category than your standard auto and home and umbrella. So if you're going to be wanting them to take on your rental properties, financially, you're going to be better served to give them all of your business and say, let's look at everything, take the good with the bad, so to speak, and then you're probably get a better value that way. You'll be able to seamlessly cover your liability should it be all in your name. add a personal umbrella that would cover your personal interest in the property as well as your personal assets. So by combining everything up, you can really get more bang for your buck, so to speak. If you're a first-time investor and you're buying your first few properties, that's the way I would go about it.
Yeah, I know that in my case, and I don't want to name names of insurance companies, but you've set me up on, like my auto insurance is through the same provider that the policy on one of my large apartment complexes is. And that actually saves me money on my larger apartment complex because there's a discount for having multiple insurance policies through the same provider.
Exactly. Looking at things creatively, which if you're taking the time to really go through the individual's account, those are the things that come up. The agent or the person out there who's not asking questions about their client is really doing them a disservice because they're not going to know how to best serve them and add different discounts. And for one thing, RPOA discount. There is some companies out there that honor the Rental Property Owners Association of Kent County as a nice savings. So knowing that and having someone ask you the right questions can really be a service to that individual client.
Well, that's interesting. Let's talk about that because this podcast is brought to us by the RPOA. Mm-hmm. What kind of discount do some of these providers offer for being an RPOA member?
There's one provider that I know of that I represent, and it's 9 to 10%.
9 to 10% off the
off value of a commercial package policy. So,
if it's $1,000 a year, that's
$100.
That's $100 right there that you could be saving.
Yep. So for those of you out there who are thinking about, I don't know if it's worth the $200+ to join the RPOA. Well, there's 50% of it back right there.
Awesome. I love that organic plug for the RPOA. That's great. Well, and let's get specific to my situation. For the Wyoming 200 unit, you've set me up, not only is the provider providing the insurance on that property, but you also set me up personally for my auto insurance and one other policy.
A life insurance policy.
A life insurance policy.
Yep.
And by doing that, what's the percentage that I'm saving each year on the larger insurance policy?
Between the auto and the life, give or take, I think it's between 8 and 10%.
8 and 10%, mm-hmm. Which actually is quite significant given the size of that other insurance policy.
For example, let's say an individual's policy is $10,000. That's basic math, guys. And so it's real savings, and you're adding a service and additional policies in your household that you're buying anyway.
Mm-hmm. So let's get back to the investor who comes to you and is looking to get insurance on whatever it is, a duplex, a 4-unit, a 12-unit. What are some of the mistakes that you see being made in assumptions or just running the numbers as far as insurance is concerned?
Well, when someone's looking at a brand new property, we want to look at it too, just like they're looking at it with a critical eye. Myself personally, I would get out there and kind of field underwrite that risk right with the investor and say, let's take a look at make sure everything's been updated properly. Things the city looks for your certificates are a lot of the same things that the insurance company is going to look for. Code issues, handrails, trip and fall hazards, electrical being up to date, HVAC being up to date, plumbing, roofing, all those curb appeal type things insurance companies look for. They want to mitigate the likelihood of losses. So getting into a project, you want to make sure and budget for that if it's not been done, or look for that if it has been done.
So I know that on a lot of my properties lately, and this is a trend within the past 2 years, one of the major insurance providers has come out and said every unit must have 100 amps.
Oh, yeah.
Otherwise, we are not going to insure you.
Yep.
And this causes a lot of problems for investors here in West Michigan, especially Grand Rapids, where some of the investments are 100 years old, and they do not have 100 amp service to each unit. So the dilemma is, do I spend upwards to $10,000 per unit to retrofit 100 amp electric? Or do I get a different insurance policy? But then if I have to go get a different insurance policy, I'm probably going to pay a lot more. So let's talk about that.
Yeah, well, and oftentimes company A to company B, they're going to be looking for the same thing. You just don't know it yet. I can only speak for the 5 to 6 companies that I represent, so I know how they work. But yeah, if you don't want to upgrade your electrical, you can go to a different company and pay more year after year after year. But eventually, that upgrade's going to be made. So, Brian, you can speak better than I could since you're the investor here. You build it into your capital improvement budget.
Right. I guess the message there is you have to understand what insurance companies, not only what they're insuring now, but what they're going to want to insure in the future. And I think this 100 amp per unit thing is a perfect example. If that is the trend, and less insurance companies are willing to accept anything less than 100 amps per unit, you have to assume that in the next 5 to 10 years, you are probably going to have to spend that money to upgrade your electric. And we've done that on some of our properties. But this brings up another key point, because the insurance company they dropped 3 of my properties this past year. They said, we're no longer going to be insuring your properties. There wasn't even an opportunity to pay more to have them insure. It was just, you're done, bye, see ya. So I came to you. And I think the difference, and this is where I want you to talk about yourself a little bit, and the way you do your business, is you have multiple providers. So you're an insurance broker.
Independent agent would be
Okay, independent agent. And talk about that and the difference between other styles of insurance.
Yeah, there's really 2 systems out there. There's the captive system, which everybody knows. I would consider them the big box companies. When you're watching the Final Four, they're the ones who are advertising. Then there's the independent companies that are committed to my type of a system, where they want to work with an agency that they know they have 5, 6, 7 companies, and they're all competing against each other. And they position themselves in such a way that they're going to get a percentage of your business. They don't want it all. They want just what they target. So really working with someone who has multiple choices is going to be able to better serve that client. Well, Brian, let's look at what we have together. We won't name companies, but look at 3 or 4 different of your investments. I bet you have 3 or 4 different companies involved.
If I look at I probably have you and one other insurance agent involved, but between you, there's probably at least 4 or 5
at least
companies that are insuring my properties.
They're all highly A plus rated as far as financial stability, so that's not the issue. But every company might target a different size. If you're working with a Michigan only company, they might want only insures a value up to $10 million. If you're working with a national or more of a regional carrier, they'll insure a $20 to $25 million, replacement value on a property. So it all depends on what the appetite is for the company. But as long as you have someone that has multiple choices, they're going to find something that suits the investor.
And as a side note, one of our stories is that when my 3 properties were dropped, and this happened within the past 6 months, when they were dropped by my previous insurance carrier, that agent was able to get me quotes from other companies, but they're not a broker, but yet they were able to get quotes from other companies.
Well, there's a standard market and admitted carriers, and there's excess companies, excess lines. So surplus carriers where they can charge an exorbitant amount of money. They tax the premiums. There's a surplus tax. There's a state tax. And they know that they kind of corner the market. So, hey, if you want policy, we'll find you one just for the right price.
Right. So when they came back to me with that price, and
three or four times,
maybe? 3 or 4 times what I had been paying.
Yep.
And you were able to come back to me because you have more carriers that you work with.
Exactly.
You came back and your prices were a quarter to a third of what they would have charged me had I stayed with them.
Yep.
So I think it's important for investors out there to realize, it's great if you have a good relationship with your insurance agent. That's fantastic. But you also have to look at the product that's available to them. And if they don't have a wide array of products, you may not be getting the best price.
Yep, and coverage goes right along with that. I might have just company A that I represent. I'm a captive agent. And if your risk doesn't perfectly fit in company A, we'll give you some coverage, but we might not be able to offer the whole list of things you need. So, working with someone who has choices is always to the client's advantage for multiple reasons: coverage, price, and overall value.
Now, let's talk a little bit about something that you educated me on, which is the different values that are placed on a property when you insurance. You have the Well, just talk about it.
Yeah.
Because if I try to explain it,
Oh, come on, Brian. I'd love to hear it. No,
The replacement cost, and what's the other one?
actual cash value. So let's keep it real simple. Let's talk about a duplex. Market value or the actual cash value is $100,000, but the duplex is 1,500 square feet on each side. So it's about a 3,000 square foot property. Replacement value on it, let's use $100 a foot, $300,000. So the investor buys a property for $100. They don't want to insure it for $300. And the insurance company might not want to put $300,000 on it. It's more of a moral hazard, so to speak, to create a value that's so much higher, three or four times the market value. So they offer what's called an actual cash value settlement option on that property. Let's say you insure it for $100,000 or $125,000. It's not going to get you replacement cost coverage. So not to bore anyone out there, but replacement cost is new for old in the event of a claim. An example would be a roof. Windstorm comes through, blows a roof off. You get a brand new roof paid for, less your deductible, here's your check. The same roof on actual cash value is going to be, well, the replacement cost is $10,000. The roof's halfway through its life, so here's $5,000 minus your deductible. Here's $4,000 on a $10,000 roof. That's really how actual cash value works.
Okay, so I'm gonna repeat what you just said and tell me where I'm missing the mark here.
Yep.
So you've got actual cash value. If you go buy a duplex for $100,000, the actual cash value of that duplex is $100,000.
Give or
but
take.
you might insure it for a little bit more just to give yourself some cushion there.
Or if you're making some updates, cosmetic updates, or
Exactly. So
yes.
okay, you
Yep.
put in some new mechanicals. You'd insure it for $120,000.
Exactly.
say. All right, great. That's actual cash value, as opposed to replacement value, which is if that duplex were to burn down and you were to build it from new, the replacement value might be $300,000.
It's based on the light, kind, quality, and size of the building. So every different company out there is going to have their own calculation. Roughly, let's use $100 a foot, but the replacement cost on that same thing is going to get you a new building in place of the old building in the event of a claim. Actual cash value will only get you basically your investment onto that in a total loss.
Right. Okay, so pros and cons here. So actual cash value, if I insure for actual cash value, it's probably costing me less per year. Is that correct?
Significantly less. Your coverages might be limited depending on what type of product, but for the sake of this today, you're going to save money. You're not going to sacrifice any liability. You're just talking about the physical damage portion of the policy.
So the liability part, which is if someone slips and falls or
Always going to be
a roof shingle falls
that $1
on
million.
their head.
You're always going to have that high limit if you're working with someone that's making proper recommendations. So that has no bearing on replacement or actual cash value.
Okay, so the liability is the same for both.
Absolutely.
It's what happens if there's a fire or a tornado or an earthquake, something that destroys the property.
No earthquake coverage in Michigan here, Brian.
Oh, okay. Well, I used to live in Los Angeles.
That's right.
So I don't think we could even afford earthquake coverage.
That's
in Los
right.
Angeles.
So we do have flood, and you know that.
Oh,
we do
yeah,
offer
we'll talk
flood.
about that,
So we'll
yeah.
talk about that. But yes, if you want to know more about this, obviously we can talk on an individual basis. But replacement cost, actual cash value, they both have their place in the market. The investor that has that extra buffer built in or budget built in to self-insure for some things might be more of a candidate for actual cash value. The newer investor who's buying a property and they're not getting a great deal on it, they're paying more of a comparative price for today's market. I mean, you're not going to be able to go out and find the deals anymore out there. Well, at least not as many. So if you're paying a couple $100,000 for a property, I'd probably insure it for replacement value. Because you can't afford to take a hit should you have a partial loss.
Right. So because this is key here, and I don't know if you mentioned this, but with replacement value, if let's say all the siding is blown off in a storm, replacement value would just pay for the replacement of that siding.
Yes.
As opposed to actual cash value, where they might depreciate that siding based on when it was installed and how old it is.
20, 30, 40%.
So let's say the siding's been on the building for 30 years, it's fully depreciable. Is the actual replacement value going to cover it?
They'll cap it. Cap it. Replacement cost, no matter the age, is going to replace it new for old, the event of a loss. Similar light, kind, and quality. You might not be able to get aluminum siding anymore, but we're certainly going to get you some nice vinyl siding. But it's not going to be an out-of-pocket cost beyond your deductible. Actual cash value, there can be some unknown costs. That's why I would encourage, and this is not really my side of things, but I would encourage that investor to have a nice little escrow self-insured fund built aside for themselves just in case they have an unexpected on a property that insurance isn't fully covering.
I see it as kind of a before and after thing. Before anything happens, you're going to do better with actual value insurance.
Cash value insurance.
Actual cash value insurance, because you're paying less for it. So your cash flow is going to be better. But after a tragedy occurs, or not a tragedy, but a
windstorm
some sort
or
of
fire.
disaster occurs, you may wish that you had the replacement value, because that's what's going to cover you better in the case that happens. So it's really about your risk tolerance.
Yes, it is. And there's always options. So I would encourage you out there to look at both. Make sure you have that discussion up front. And it's always good to be educated. You don't need to be an expert, but you're educated enough to know the difference between the two, look at the cost between the two. I would encourage high deductibles out there. So if you want the replacement cost, but you don't really want to pay a ton more, you can offset that by self-insuring for a $2,500 or a $2,500 or a $5,000 deductible.
And by self-insuring, do you mean you just have some money tucked away in the bank
Yeah.
in case something happens?
Yeah, so you can absorb that $5,000 deductible, but over the course of time, that $5,000 deductible saving you $500 to $1,000 more a year. Well, there's a payoff involved in that. Over the 5 years, you're gonna recoup that money. So, and it all depends on everyone's personal financial situation. But I recommend options. I recommend going through what's available to you and making sure that you have everything on the table to make the proper decision for you, because everybody's situation is just a little bit different.
Right. And having those options, because you usually give me 3 options, and we should talk about deductible,
Yep.
but you'll give me an option saying, okay, here's the actual cash value policy, here's the replacement value policy, here's the different deductibles you can have. I wasn't that enlightened when I first met you, so even deductibles were confusing to me.
Yeah.
So let's talk about that for the...
Yeah, a deductible. Well, there's a lot of homeowners out there. It's the same as a homeowner's policy. So what are you, what skin in the game do you have to put up should there be a loss? So if there is a windstorm that comes through and blows off, let's go back to the shingles again, Brian, that goes back and blows off the roof costs $10,000, insurance company is going to submit you a check for $9,000 if you have a $1,000 deductible. You can go as low as $500, but on any investment property, you want to keep the little claims from going to the insurance company. Self-insure for anything small, because frequency does have effect on your rates long term.
So the more you go to your insurance company and say, I need you to pay for this leak and the damage that happened because of it, what does that mean? They're going to jack up your rates?
Yeah, because you don't want to have your claim frequency be used up by $1,000, $2,000, $3,000 claims. You want to make sure that you're saving it for the large losses when you really need it. Having a good handyman or a good manager is going to help you avoid small little nickel and dime type claims. Same thing with having a larger deductible. It's going to change your mindset on things. You're going to self-insure for anything small and leave anything over $2,500 or $1,500 up to the insurance company. That way, you're really saving your insurance company for the major loss. Mm-hmm. And you're saving your budget by having a higher deductible. And ultimately, the long-term health of that policy is going to hopefully maintain a more level premium.
Mm-hmm. Yeah, I tend to, not that I'm recommending this, but I do tend to keep a higher deductible. And I only file insurance claims if I feel it's absolutely necessary, because the cost is so high that it makes me cry.
Well, you would.
That's my threshold. If I cry,
clarify, Brian. There's a difference between the apartment investor and the single-family duplex 4-unit type investor. There really is, because the cash flows are significantly different. So you can absorb a lot more when you have more reserves. You can probably explain this better.
Well, exactly. So, like on our 200 unit in Wyoming here, our deductible is $25,000. But
let's tell a story.
Yeah, and let's tell a story.
Yeah.
We had a fire in one of the units
last March, I believe.
Last March, thank you. And the unit was completely gutted. The cost to rebuild that unit, and luckily no one was hurt.
Yep.
And the fire was contained to the unit, which was great. And the fire department got there quickly, put it out. But the unit needed to be completely gutted and replaced, and everything inside of it was destroyed. The deductible was $25,000. The cost to do everything we did was about $24,000. Which
Funny how that works out.
It's like they knew.
Yeah.
But it means that basically we eat that cost. Now, we have over 200 units there, so the cash flow is where we need it to be so that we have that reserve. It didn't really hurt us as far as the cash flow went. And we did have the money to do what we needed to do. Good story for that nobody was hurt. But the other part of that, which is that the tenant had renter's insurance.
Surprisingly, but we always recommend that to larger investors or even the single family. Renter's insurance, everyone. Make sure it's in your lease, that you recommend it, you offer it, you recommend whoever as the agent. Please advise your tenant. You can't make them do anything, but you can advise them.
Make them do it.
To purchase renter's insurance because it gives them their own liability limits, their own medical payments limits, their personal property limits, loss of use. It puts them up in a different apartment. The Red Cross isn't going to have to get involved and make sure that they have a place to stay for a few days. They're going to get moved right over to probably another one of your units.
Which is what happened.
And it's being paid for. So renter's insurance can help the landlord. It can help the tenant, everybody involved. It just makes the time of crisis that much easier.
And so this tenant did have renter's insurance, and our hope was that we could go and recoup our costs through their insurance.
Subrogate against the other insured.
Exactly. And that's a process, and we're going through it. It's looking more and more likely that we probably will not get that money. I don't know if I really want to go into why, but I will say to anybody who's listening, if you have an insurance claim like I'm discussing, talk to me. Give me a call because I'll give you a couple tips on how to navigate that.
We also try to assist you as best we can, communicating with the other companies involved.
Yeah, I would say in the case of a large loss like that, absolutely get your insurance provider or your agent involved as soon as possible. If you're going to go after someone, get a lawyer involved as soon as possible because there are games that the insurance companies play. And this was a tenant's insurance policy, but there are games that are played right from the very beginning that come back to bite you later on. So get your insurance agent involved, get a lawyer involved right from the start on a big claim.
And also the RPOA. Again, I'll plug the RPOA. They have resources for landlords out there on a whole mess of issues that you don't think of until they come to light. So they definitely can assist you with paperwork, with connecting with other investors who have had similar stories. It's just a great resource for a new investor or a savvy investor out there.
Let's move on to more tragedy stories, or more
Tell you a story
where you saw something happen that had they thought more about their insurance in the beginning wouldn't have happened, or just anything like that.
Anybody you have work on your property, collect a certificate of insurance. So I'll use an example. The apartment complex. You have a heating and cooling contractor coming in to replace water heaters and furnaces and the units as they turn. Make sure you know that contractor is fully insured in case they cause property damage or liability issue on your property. That way you can go after their insurance policy and not have to use your own for that water heater that burst that was improperly installed. That's number one. Anybody that's coming on your property to do any sort of maintenance, upgrades, general day-to-day insurance certificate, I would require it before I let them step foot on my property. When they have a bid, please submit your certificate of insurance. That should be commonplace.
Have you seen instances where that has not occurred and someone's gotten in trouble?
Yeah. I had some guy, he gave me a great price on a roof, and he upgraded my roof. Okay, great. Well, now the roof's got a big problem, and it's causing a whole mess of interior problems, and they can't go after that guy because he's skipped town and doesn't have an insurance policy, and magically they're unavailable.
That happens quite a bit.
It always makes it a lot easier if they say, well, geez, this is something I don't want to absorb personally as the contractor, but I'll turn into my insurance company because, I'm legally liable for this. Well, and I caused property damage, it's not a warranty on my work, but the ensuing damage would be covered.
What are some other mistakes that you've seen being made, especially by investors?
Having too many companies cover the same entity. Let's just go ABC LLC owns 10 properties, and you have three policies insured with one company, 3 policies insured with another, and the other 4 insured with another. Well, no company's going to have the same coverage, matching up from company A to company B to company C. You want to make sure that you're uniform with your liability. Oftentimes I clean that mess up by fixing it, putting it on one package, getting the liability limits proper. Your deductibles are all scattered in the wind now, they're even. Just organization, number one, can lead to coverages not lining up. So having, and oftentimes that happens when you buy a property in May of 2016 and the next one in May of 2017 and beyond, and you don't have it line up with the same person.
Mm-hmm. Great. And let's talk about a couple of things that I've noticed, and you can chime in here. One thing I see a lot with, especially, any property, it could be any size, is that the broker who's selling the property will come out with a pro forma. And the insurance line item on that pro forma will basically be what the previous owner was paying for insurance. So most investors would take that number and say, well, if they were paying $800 a year for insurance, that's probably what I'm going to pay. What would you say to that?
Well, the insurance companies probably had an experience with that client or that previous owner that goes far beyond what they're putting on paper. Their loss experience, their payment history, their volume with that individual company might affect their rate. Or as we talked about earlier, they might have all sorts of multi-policy credits that are tied into that $800 rate you spoke of that you have no idea what's involved. So ultimately it ends up that they're paying $800, but without everything I just described, they might be paying $1,800. Mm-hmm. So if I went in and bought that same property, they're going to look at me and say, well, you have no experience as a landlord. It's your first one. We don't know how you're going to manage it, how you're going to keep it up, and if you're going to pay your bills. So we're going to charge you relative to what I just described. So over time, good experience with the company, it's going to drop that rate and keep you more level. But in the beginning, an investor looking at that pro forma should really be talking to someone up front. And as you always do, months ahead of time to get your budget in order, because things aren't always what they seem.
Right, exactly. So I would make two recommendations.
Yep.
One is contact the insurance provider early on in your due diligence, the one who is providing the current insurance for the current owner. When you're purchasing a property, part of your due diligence, contact them and say, if I buy this, what is the insurance going to be for me? What are you going to be looking at? Where might it change? Because you're right, they might have other policies that are giving them a discount. I also think there's kind of that sleeping bear thing, where if you poke a sleeping bear, you never know what might wake up. With the 200 unit plus that we purchased in Wyoming, well, it turns out that a portion of one of the buildings was in a flood zone, and the previous lender, and this had to do more with the lender than the provider.
Yep.
The previous lender, that was not an issue to them, but our lender, because it was a Fannie Mae loan, they had to go by the FEMA requirements. So we're now paying quite a huge sum for flood insurance, which we had no idea we were going to have to do. So that's one recommendation. When you're doing your due diligence, contact the current insurance provider. But the other, even more important item is have an insurance broker on your team who you can call up, and I do this with you all the time,
Yep.
and I say, I'm looking at this property, it's at this address, here's what I know about it. What do you think my insurance would be? Give me a ballpark
We do our
numbers.
best to narrow that down. You never hold me to that number, and thank you. But we do our best up front to give you the most knowledge you can to make a proper financial decision, because we want to be in it for the long haul with you too. We want to maintain your business over the years, and we've probably worked on 3 or 4 projects that have never come to fruition. But at least you knew you were making proper decisions, getting involved. Another thing, going back to that pro forma $800 number, you don't know if they were insuring it for the bare bones basic coverage because they were owned it outright with no bank involved. Your lender might have a lot to do with your insurance requirements, as you know, as of last year.
Exactly.
Just like you're describing getting into the flood, there might be a lot more boxes that lender wants to make that investor check when it comes to their insurance than the previous owner did. So you might be held to the standard of who your financing company is as well.
Right, and I think that because FEMA, I'm not an expert on FEMA, but I keep hearing people say, well, they've changed their maps recently. So properties that may have never been in a flood zone might suddenly now be in a flood zone. So I think this goes not just for investment property, but for personal property. If you're buying a house or a duplex or any, up to a 500 unit apartment complex or any sort of property, you need to double check as part of your due diligence that it's not in a flood zone. And you can go to FEMA's website to find that out. But also when you do your survey, they can tell you as well.
Yep, we can help. We have a couple of flood insurance companies that we represent that we can actually help with the policy, but we can also help determine what flood zone it's in and the most current flood zone, because those things are often revised.
Okay, so as a part of the service you offer, you can say, look, this is something you need to be aware of.
Very simple.
Flood zone.
Very simple. Mm-hmm.
Yeah, well, our property, our 200 unit, one of the buildings, just a little corner of the building is in a flood zone A, which is a 100-year floodplain. But that has added a significant amount of insurance cost to the property.
Thank you, Fannie.
And that's because Fannie Mae has very specific requirements as to what they want to see in the insurance policy. In fact, we have 2 insurance policies because of that flood zone.
Don't even want to go there. Don't even want to go there.
Okay.
So, but yeah, private money.
Yeah. If you can pay cash, then you don't have those lender
That's
requirements. Right. You can self-insure and not have to worry about that. But if you are getting any sort of loan, your lender quite often will weigh in on the type of insurance, and they want to be named on the insurance policy too. Is that correct?
Yeah, because they have a financial interest, so they want to be named as the mortgagee. And believe me, they'll let you know if they don't get what they need at renewal. They're very vocal.
Mm-hmm. Tell me, as we wrap it up here, tell me a story about you see all kinds of claims, I'm sure. Mm-hmm. So you insure all kinds of properties, you see all kinds of claims. Tell me a story about where someone had the right insurance and things went the way they were supposed to.
Okay. Well, I'll just take it to a basic homeowner's policy, which can just be like an investor. Let's just say it's a single-family home. It was on replacement cost coverage. There was a fire smoldering in the attic that got enough oxygen where it kicked up, and the homeowner was displaced for 6 months. I think we paid out upwards of $175,000 on a partial claim. All the while, we were paying for them to have alternative living situation. All their contents were replaced because they took our advice and documented their contents, documented their belongings via video, iPhone, Droid, whatever you have. That's another thing we didn't touch on, but I'll touch on it now. Documentation of anything inside that building, having photos on file can make that claim go so much smoother. So yeah, that every now and then you do get a thank you letter, even though we're the big bed insurance provider. You get that thank you letter saying, hey, this was really good, and we haven't had any issues. Nobody likes to be displaced and have their life interrupted for 6 months, but when it does happen and it goes the right way, it feels good knowing that you were able to help that person.
Great. That's a great place to wrap it up. Unless there's anything that
I appreciate
to touch on.
I appreciate being involved, and if anyone needs to talk to me personally, Brian can certainly share my information.
Yeah, and we'll also have on the RPOA website, we'll have a podcast site where you can get more information about the episode and contact information for you if you'd like to provide it.
Yeah. Well, thank you for having me.
All right. Well, Mike Murphy, thank you very much.
Thank you.
You've been listening to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owner Association. You can find out more at rpoaonline.org. If you enjoyed this podcast, please go to iTunes to subscribe, rate, and review.